Hello everyone, I hope you're having a great day. Today we are going to look at one of the many regulations imposed on banks and thrifts by the federal government. The regulation we're looking at today is Part 2, 12 U.S.C. 24. Now Part 2 is entitled Prohibition on Taking Certain Private Remuneration in Connection with Credit Life Insurance. So let's take a look at what this regulation does. First off, we'll cover the basics. Then we'll dig into some nuances. And finally, we'll see how this regulation impacts banks and their customers. Before we jump in, please like this video, share it with others, and subscribe for more videos like this one. You can find links to additional resources in the description below. All right, let's go. Part 2 outlines what bank employees, officers, and even principal shareholders of a bank cannot do. They cannot accept any private remuneration in connection with the sale of credit life insurance, health insurance, accident insurance, disability insurance, and mortgage life and disability insurance. Now remember, this is any type of insurance that is designed to pay off a loan. In other words, if a borrower dies or becomes disabled, this insurance will pay off the outstanding loan balance. But who does this regulation apply to? Well, it applies to every national bank, Federal Savings Association, and the employees, officers and directors of those banks, and also principal shareholders of those banks. And just to be clear, a principal shareholder is any person that owns more than 10% of any class of a bank's voting securities. Also, any spouse or minor child of any of those people in any entity in which those people own more than 10%. Now you might be thinking, what does this mean? Well, this means that no national bank employee, officer, or director can accept a commission bonus, stock, or other private remuneration for selling credit life insurance to a customer. This is true even if the bank itself would otherwise be entitled to receive the income, but perhaps overlooked it or didn't ask for it. This is significant because it outlines very clearly that no one is allowed to profit directly from selling insurance products to customers. So why does this regulation exist? The main reason is to avoid conflicts of interest. Imagine a situation where a bank employee is responsible for approving loans and also earns commissions on selling credit life insurance. In this scenario, there is an inherent conflict of interest. The employee could be tempted to push customers into purchasing credit life insurance regardless of whether it's actually beneficial for the customer. This is not only unethical, but it can also lead to severe consequences. The primary concern here is that the employee's actions are driven by self-interest rather than what is best for the customer. That's why the regulation prohibits taking certain private remuneration in connection with credit life insurance sales. The idea is to ensure that employees remain objective and act in the best interests of their customers. However, the regulation is not absolute. There are a few important exceptions to this rule. The first exception pertains to bonus and incentive plans. According to the regulation, bank personnel can participate in bonus programs based on the sale of credit life insurance. However, there are limitations in place to prevent excessive personal gain. The annual payment to any individual under these plans cannot exceed the greater of either 5% of their annual salary or 5% of the average salary of all loan officers participating in the plan. This provision allows banks to incentivize employees to sell credit life insurance, while mitigating concerns about conflicts of interest. By limiting the bonus to a reasonable percentage of their salary, the regulation ensures that employees are not overly incentivized to prioritize insurance sales over other aspects of their job. There's another exception for third-party contractors. If an individual works for an entity that has an arm's-length contract with the bank to sell financial products on bank premises, they are exempt from the private remuneration prohibition, provided they aren't involved in the bank's loan approval process. To qualify for this exception, the individual must not be an employee officer, director, or principal shareholder of the bank, and their compensation must not be based on the bank's credit life insurance sales. This exception is intended to permit non-bank affiliates to sell insurance products within a bank's premises as long as they operate independently from the bank's lending decisions. This allows for greater flexibility in distribution arrangements without compromising the integrity of the lending process. For example, let us say a bank decides to partner with an insurance company to offer additional financial products to its customers. Employees of the insurance company could work on the bank premises and receive commissions on insurance sales, as long as they are not involved in loan approvals. This allows the bank to provide a wider range of financial services to its customers, while still complying with the spirit of Part 2. The next exception is for affiliate and compensation arrangements. Affiliates of a bank holding company can receive credit life insurance income without violating Part 2. However, the bank must receive reasonable compensation for using its name, premises, employees, or goodwill in connection with the insurance business. What is considered reasonable compensation? According to the regulation, reasonable compensation is generally at least 20% of the affiliate's net income from credit life insurance sales through the bank. This provision recognizes that different entities within a bank holding company may engage in various financial activities, including the sale of credit life insurance. By ensuring that the bank receives a minimum share of the affiliate's net income, the regulation promotes fairness and prevents exploitation of the bank's resources and customer base by its affiliates. In addition to these exceptions, the regulation also addresses situations where bank personnel act as licensed agents for selling insurance. In such cases, as long as their compensation is based on the sale of insurance and not on bank credit life insurance sales, they are not prohibited from compensating the bank for using its premises, employees, or goodwill. This exception recognizes that bank personnel who hold insurance licenses may engage in insurance sales activities separate from their roles at the bank. Finally, Part 2 contains record-keeping requirements. Banks must maintain records related to credit life insurance sales, including contracts with affiliates and third parties, as well as documents supporting transactions exempt from the private remuneration prohibition. These records must be made available for examination by bank regulators upon request. Record keeping is essential to ensure transparency and accountability in credit life insurance sales activities. So to sum things up, Part 2 aims to create a level playing field by prohibiting bank employees from profiting directly from selling credit life insurance to customers. It seeks to ensure that financial advice remains objective and in the best interest of the customer, rather than being driven by sales targets or commissions. The regulation acknowledges that there are situations where third parties or affiliates may play a role in insurance sales and provides exemptions accordingly. It also clarifies that bank personnel acting as licensed agents can compensate the bank for using its resources while still complying with the spirit of the law. By implementing these measures, federal regulators aim to protect consumers from potential conflicts of interest and ensure that the sale of credit life insurance is conducted ethically and responsibly. Let me know what you thought about this video in the comments section below. Did you find it helpful? Did it give you some insight into this topic? Please let me know. Also remember to hit the like button, share this video, and subscribe. Thanks for watching. See you next time.